you're clearly very well versed on banking and insurance regulation, and both regimes have been have undergone a lot of overhaul in the last few years, and insurance is definitely going through that overhaul now. So the first question I'd like to ask you is, what do you see, if any, as the major parallels between Basel III on the one hand and Solvency II for insurers on the other hand?
Right. I think we have to be careful when we're asking this question, because obviously there's a lot of parallels. If we take the two frameworks and we look one against the other, we can see that they both have a market risk module and they both have a credit risk module, and they also have an operational risk module. So you could very easily say, well, actually both of them are dealing with the same risk types. Very often both insurers and banks have positioned the same financial instruments. Therefore the parallels make a fair bit of sense to analyze, and the consequent question that comes up very often is the current divergence in regulations appropriate? Shall we start bringing things closer together? I don't have a very good answer. This is a fundamental question of my research, but at the same time I'm saying that we need to be very careful to pay attention to the differences in the business models between the two firms. So when we're looking at an insurance firm and when we're looking at a banking firm, the type of market risk that they're taking on, the type of credit risk that they're taking on are very often different. Sometimes they're not, but sometimes they are. So in terms of the parallels, for me, the parallels need to be viewed in the context of the business model itself, liability-based on the one side, asset-based on the other side, maturity matching on the one side, maturity transformation on the other side, and some of the fundamental business differences, such as insurance firms are pre-funded and technical provisions are absorbing some of the losses immediately. Within those lenses, we can start seeing at the parallels, and from there on, I think the discussion on the parallels starts shifting from are the two regulations comparable to versus do the regulations, given the business model, achieve the appropriate objectives for its section, its sector, but also for the financial system as a whole.
And I guess following on from that, what about timing? What do you think about timing? Because for banks, Basel III seems to have come at a time when the crises have happened, and it's almost a kind of how to fix and prevent future crises, whereas Solvency II it feels preventative. I mean, to what extent do you think Solvency II is going to be able to prevent future crises for insurers?
Right. I think predictions are generally quite difficult, and even more so when they pertain to the future. So I'd rather try not to respond to this directly. My favorite anecdote is that I was working, I left asset management in 2003 when I was in London to start a Solvency II project back then, and we're about 12, 13 years later and we're still on the making. I think the timing, I don't think the timing has to do with prevention or not. If I look at it on a historical trend, I would say that insurers are generally better managed from a risk perspective, has generally had lesser losses and lesser volatility than the banking counterparts, unless, with the exception obviously of some insurers that were acting like banks, and it's AIG, the one that I've got in mind. I think the timing is more, is not really a consequence of regulations, or the regulations I don't think are driven by the timing. It's more the fact that the banking regulations were developed at a specific time. The crisis came about, and then we had to do a lot of overhaul to the original banking framework. From an insurance point of view, it is de facto becoming preventative, but if we look at, as I said, insurance history, I think we do have significantly less losses in that sector. Of course, that doesn't mean that we should not be careful for a potential disaster in the future. And the one thing about some insurance losses is that they are totally unpredictable, like things like pandemics, etc.
Okay, thank you very much.
All right, thanks.